Hi then, good morning, everybody. Thank you very much indeed for joining us on this Wednesday morning. Great to have you with us, and great to have so many of you with us as well. You know, the sign up for these Pulse webinars that we do are really good, and that's why we keep doing them, really. So, yeah, but thanks again for signing on. Very pleased to have Mark and Jim from Waverton with us this morning. And what they're going to do in this presentation is sort of kind of take a fresh and almost contemporary look at the age-old active versus passive debate. And I think it's going to be a really interesting one. I think that sometimes maybe as an industry, we're guilty of taking what we know for granted and starting to view things perhaps like this debate as old hat. But actually, for the average client that we're speaking with, it might be something that they're completely unaware of, and perhaps worth bringing back to the forefront of our minds and seeing where it fits in the current landscape. As always, if you've got any questions as it goes along, please do submit them using the chat function on Zoom, and I can pitch those to Mark and Jim. We should hopefully have some time at the end for that. But yeah, without further ado, I will pass over to Mark. Yeah, thanks very much.
Thanks, Darren, and morning all. Just for introductions, Mark Barrington, Head of Sales at Waverton, Jim Mackie, one of the portfolio managers within our managed portfolio service. I'll do a very brief introduction to Waverton for those that don't know us, and then I'll hand over to Jim for the meat of the presentation. And as Darren said, if you've got any questions, please do post them, and we can deal with them at the end of the presentation. So Jim, maybe if we just move on to slide number 1. Quick intro to Waverton. Gosh, we were founded nearly 40 years ago now, in 1986, as a company that many of you may be familiar with, J.O. Hambro Investment Management. We are predominantly DFM. We've grown organically to just over 12.5 billion of assets. On the Novia Global platform, the main way to access Waverton is through our managed portfolio service, the MPS, and that's around about 4 billion of that 12.6 billion of assets. So quite a significant chunk of money within the MPS portfolios. Some of you may have picked up, we recently merged with another company, London and Capital, that will boost these assets under management from about 12.5 billion to over 19 billion. L&C also have a strong overseas presence, so hopefully that will help us to be able to boost what we can do for our overseas advisors and supporters. Final thing just to say about Waverton specifically is that we're independent. We're not owned by a big life company or anything like that. So what we put into our portfolios is what we think is best for your clients. Jim, do you want to move on to the next slide? I won't bore on too much about this, but whether you access Waverton through our MPS, through multi-asset funds, or on bespoke portfolios, the investment approach will be the same. And I'll just try and very briefly draw out a couple of points of differentiation, if you like, points of difference of our approach. Perhaps from your perspective and from your client's perspective overseas, it's important to mention, first of all, that we're global. So our portfolios are genuinely global. A lot of UK investment companies will probably have more invested in the UK than elsewhere. That's not the case for us. We probably have 5 to 6% in the UK typically, but a lot more in the US, Asia, and other overseas markets to the UK. We're very much an active manager, so you won't see a lot of passive vehicles, if any at all, within our portfolios, and for that reason we're often put alongside a more passive solution. Just going down to the list, by direct engagement, and I think this is a point of differentiation on the MPS side. Our portfolios are constructed from direct equities and direct bonds. So we're not a fund of funds house. We invest directly into equities and bonds. That helps to keep the costs down. The MPS is typically between 60 and 70 basis points total cost. That includes our fees. And it also gives us more control over the portfolio, for example, in things like ESG, understanding all the moving parts and so on. And the reason we can do that is because within Waverton, we have what we call a centralized investment team. So rather than have portfolio managers looking after clients, trying to prospect for new clients and also analyze stocks, we've carved out the analysis part to a separate team, over 30 people. It's award-winning. They're all just specialists in their area. They just sit in the corner analyzing their favorite markets and doing nothing else. And it's those ideas that feed in to the portfolios and have generated the strong returns, which I'll show you in a couple of minutes' time. And then finally, and very quickly, all our portfolios target real returns. That is inflation plus, CPI plus 2, CPI plus 3, etc. Jim, can we just pop on to the next slide? So as I mentioned earlier, whether you choose to access Waverton through the MPS on Novia Global, the multi-asset funds on Novia Global, or maybe bespoke on our custody, and we can manage portfolios in UK, US dollars, or euros, it'll be the same process and pretty much the same mandate type as well. And I've just quickly captured here what our main mandates are. Probably no surprises there, from equity down to bonds and with an income option, and where they're available on MPS, where they're available on funds, and where they're available on bespoke as well. So we've tried to give the clients all the options, whatever is the best option from the client, from the client's perspective. And just the last slide, Jim, and just a very quick advert. I sort of mentioned a couple of minutes ago that the performance across the board actually for the Waverton portfolios has been very strong. I've captured this on the MPS. So these are the MPS portfolios which will be available on Novia Global, and we've shown them against the ARC indices. The MPS was launched in 2011, so we've got over a 10-year track record. We're showing 5 years here, and you can see that if you look at any of the Waverton portfolios, which are the sort of the top 4 dots, we've significantly outperformed the ARC index, for example, with a lower volatility. The volatility is at the bottom, the returns going up the left-hand side. And so you can see the returns, and we can send you more details, have been very strong, and it would be a similar sort of picture over 3, 5, or 10 years. So if you're interested, please do check out the numbers, or maybe ask Darren and Steve just to let us just put us in contact with us so we can send you some more details. I think that's enough from me. Jim, shall I hand over to you just to talk about passive and aggressive?
Thanks, Mark. I think also just to add to what Mark was saying about the investment team and the investment process at Waverton, we do offer obviously bespoke multi-asset funds and MPS portfolios. And from an advisor point of view, we have one investment team and we have one set of good ideas. So with the structure of our MPS, we're able to put all of those equities, bonds, alternatives into our MPS portfolio that we would be putting into bespoke client portfolios. So there's no, within our product offering, there's no poor relation. And at some firms I've worked at historically, the MPS has been viewed as sort of the sort of fund portfolio of funds. It's not really our best ideas. It's just a way of getting it onto a platform. So I think that's quite a big differentiator for us. But anyway, enough about Waverton. So active passive for us, this isn't going to be, this is not active over passive or passive over active. It's just about the world of passive and how it's grown over the years. And we started to look into this a while ago. So some of this data is at the end of last year. A reasonable amount of it is based on US data, but that does cross over to Europe, the UK. So forgive us for that, but the US does, in terms of stock markets as well, provide us with much more easily attainable information. And so this is looking at ETFs over the last 20 years or so, and there's now over 10,000 ETFs with $10 trillion invested in them. And that's growth rate of around 24% over that per year, over that 20-year period. So massive growth, a huge number of ETFs, huge number of options. And interestingly, we've now seen in the US, the passive funds or assets held in passive vehicles is now larger than those in active funds. And that's a byproduct of many things. It's cost, it's also the performance that, particularly in the S&P 500 index, very few open-ended fund managers that you're still able to invest in, because a lot of these active funds, when they become very successful, they tend to close them to new money. So that takes them off the radar. And so it tends to be the underperforming funds that stay open. But the index has been tough to beat. It's been difficult as an active manager to own 10% in NVIDIA, for example, because that's quite a big stock-specific risk. But in hindsight, it's where we all should have been. Then if you look at the S&P 500 index, 23% of that index is owned by passive vehicles. Does that matter? We think it could, in time, start to have a more influential effect on the market. It's just something to be wary of. And we saw it recently when the market sold off very aggressively. It was an index sell-off. It wasn't just stock specific. Yes, the tech stocks did go quite quickly, but I think that was an element of profit taking and people becoming nervous around valuations, and also just thinking that the market could fall further. But the problem with passive investing is it's often quite quick money. So it's quick to go in and quick to come out again. And it doesn't matter, or the investor doesn't care what the market's doing or the share price of the company is. They'll just buy or sell regardless. So that can lead to increased volatility, as we've seen over the years, particularly around summer months. This is peak volatility period. Any bit of bad news that comes out will be exaggerated by the lack of liquidity in the market. When we're looking at the growth of passive in the UK, majority of it has been through funds. So passive, the Vanguard passive funds, for example. Vanguard have now launched ETFs. So these are equivalents to the funds, but these are traded throughout the day, which may be advantageous for some clients. Rather than having to wait till midday for the fund to price, you can buy an ETF if it's available on the platform, and then invest whenever you want during the day, but still tiny relative to the size of the overall funds. And for a bit of fun, we thought we'd try and put into context how big $1 trillion is. And there's $10 trillion invested in passive at the moment. And here's an example of 1 million all the way up to $1 trillion in terms of cash. And I think these are $100 bills. I can't remember what the guy that put it together is. So imagine 10 of those. And I think if it was single dollar bills, if you stack them up, I think you would be able to get to the moon by stacking them up, which is a fair old way. Moving on, in terms of the outlook, we being an active manager, we've seen passive perform very, very strongly over the last 10, 15 years, since 2008. And as I've mentioned earlier, there's a lot of drivers of this, whether it's price, whether it's performance of the indexes, it's just flow of capital into the passive markets. But also quite a large determining factor, we think, is that interest rates have been virtually at zero. And if you look back since 2008 and since central banks dropped rates to virtually zero, Fed and the Bank of England and the other central banks around the world are basically saying, don't hold cash, just go and invest it anywhere. But just don't hold cash. You're not going to be rewarded by holding cash. We want to get the economy recovering out of 2008. And then as things turned out, they let it run and kept rates at ultra low levels. So tried to put them up back in 2018 or so. Then obviously we went into COVID and then rates came rattling back down. And in Europe, for a large proportion of time, rates were actually in negative territory. So it's not sort of difficult to see how passive would then perform well if people are looking just as an alternative. And you can see here, this is active versus passive. So if the green line is above the horizontal black line, that means an active managers in the US versus the S&P 500 index have performed better on average than the index. But you can see the last 10 years or so, it's definitely been the index that has outperformed. Now, it then came to us, we looked at concentration risk. And there's three distinct periods here where the concentration in the S&P 500 has been very high in the top 7 stocks. So looking on the left-hand side, back in 1973, IBM, AT&T, Exxon, Eastman Kodak, if anyone remembers Kodak film, GMCs and Xerox, they dominated the market then, 28% or so. We then go to 2000 in the middle. Again, it's tech stocks, Microsoft, Cisco, Intel, but Exxon's still there, interestingly. And you've got Walmart and Oracle. And then if you move to the right-hand side, you've got November last year, Apple, Microsoft, etc., Magnificent Seven. And that's probably, I imagine, still the same case. I can't think of any other names that would have crept in there. But in fact, it's probably got even worse in terms of concentration since then. And it was interesting to us to see this. And it's interesting that there's a lot of talk about the Magnificent Seven dominating the US market and how we should all be very fearful. But if you look at the UK market, the top 10 stocks in the FTSE 100 are 50% of the market. And no one mentions that. And if you look at, if you're buying a passive FTSE 100, or I think the all share it would apply to pretty much as well, tracker, then 50% of your client money is going into just 10 stocks or so. So significant concentration risk there. The difference there is in the UK, the sectors are more diverse. It's not just technology. You've obviously got banks, oil and gas, mining, but some would say maybe quite old industries. So, looking back historically, they have done well. They've had periods of doing well, but are they going to grow at the same rate as the big tech stocks in the US? Probably not. Now, if you overlay those two charts, conveniently, says the active portfolio manager, when we have periods of high concentration, afterwards, in the few years afterwards, we see periods where active managers can outperform or have outperformed. So it's interesting to see, is that because of a sell-off? Certainly in 99, 2000, when we saw the tech sell-off, that was the time where the greats performed well by owning all the non-tech stocks. We saw Mr. Woodford suddenly come to light. How he's done since then hasn't been much to write home about. But it's interesting to see what happens next and whether, active can start to take some ground back. Is our tech stocks going to continue to rule the world? Is Nvidia going to go to a $50 trillion company? It's currently 3, I think, at the moment. It's all possible, but I think, if we do see volatility and we do see any sort of slowdown in the earnings from those big tech stocks, it's quite a big bet to have all that money invested in one area. So when we were going through this, preparing for this presentation, we started to look around, and Waverton, as Mark said in the introduction, we deem ourselves an active manager. So our portfolios, if you look at our MPS portfolio, it's made up of 4 funds, and we invest directly in all the underlying holdings. We will occasionally own a passive tracker. At the moment, I think we've got an index-linked bond ex-UK in the bond fund. And that, from a balanced portfolio point of view, is something like 0.6% of the portfolio, 0.3% of the portfolio. And the rest is all actively invested across direct stocks and bonds. We looked at a number of peers. There's 6 here. I can't remember the names of them now. But if, for example, you look at peer 1, and these are MPS portfolios which are marketed as active. But on peer 1, for example, 68% of the underlying holdings are active, 30% are actually passive. And if I remember correctly, that company also has a passive range of portfolios. So it's not like they only have one range, they have an active and a passive, whereas their active is actually 30% passive. And it gets worse if you look at peer 3, that 53% of that portfolio is actually in passive investments, which means if you, as an advisor, are blending that peer 3 portfolio with a passive for your client, you're actually 75% passive, which is certainly a trend we've seen increasing in terms of the passive holdings amongst our peers. Cost, I think, is a big issue because active funds are not reducing their fees in line with anything like the way that passive have. it wasn't that long ago, when I remember iShares UK trackers were 20, 30 basis points. Now probably, if you're a big institutional buyer, they're probably 5 or so. Whereas the active guys are still charging 60 to 1%. Fundsmith's still getting away with charging 1%. So it's tough on MPS providers where they're just building a portfolio of funds, that they're trying to compete with lower cost solutions, and they're having to increase the passive weightings. And passive hasn't been a bad place to be, obviously, as we've seen in hindsight. But it came to light with us, when is active and when is it passive blend? And if you look at these portfolios in terms of the number of underlying holdings on the middle row, Peer 1, 8,700 holdings, Waverton balanced on the far right-hand side is about 1,300. And that's looking through everything. There may be some duplications of stocks in those peer numbers. So I don't think Vanguard has actually got 49,000 individual holdings. I don't think that's actually possible. So for example, it might hold Apple in different from different indices and combine them. So it may have 3 or 4 holdings of Apple. But still, it's a massive number. And does that actually generate an improved return for the clients? Well, if you look at equities, there was work done by Eugene Farmer back in 1976. And his analysis showed that with the right number of stocks and the right diversification across sectors within the market, you can have a portfolio of 30 to 35 stocks that will replicate the index. And actually, if you own any more than that, you're not actually improving diversification. So the returns as well, the volatility doesn't come down as well with more stocks. So from our point of view, having lower stocks, we don't run concentrated portfolios. Our equity fund has 60 to 80 names. I think it's about 70 or so at the moment, 70, 75. We have historically held a few third-party funds in areas such as India, emerging markets, Asia. We do have some Asian analysts, but we don't have a specific Indian analyst. So we'd rather outsource that to managers who are actually out in India, as it's such a diverse market. You need to have people with effectively boots on the ground out there. So, diversification, is it diversification or diworsification? In terms of Waverton, it was also, as we went through the research for this presentation, looking at the top 10 holdings. If you look at the MSCI World Index, which is the third column along, and then you look at the S&P 500, you see there's a huge correlation in holdings. So if you're owning a portfolio that has an MSCI World tracker, and then the manager puts in an S&P 500 tracker, you think, well, there we go. We've got world equities and we've got American equities. So that's increasing diversification. But actually, you're just buying the same stocks. And this is what I mentioned earlier about duplication. So Apple is 3.5% of the world index and nearly 6% of the S&P 500. So you're just building positions in the same stocks. On the left-hand side, we've got a couple of lists there. One is our global recommended portfolio and one's our global equity fund. You'll see very, very different stocks. Yes, we do own things like Alphabet, but I think that's the only main, and Amazon, Microsoft we've owned Microsoft for 20 years or so. But the rest of the stocks, we really do look for stocks which are the best in their sector, best in their field. We're not worried so much about geographic location. And that leads us, as Mark was saying earlier, to having quite a globally diverse portfolio. Just something that also struck us was what happens if you get it wrong and you do own stocks at the top of the market. As I was talking earlier, passive investors will just buy stocks regardless, and they will sell stocks regardless. And this is a chart of Cisco back in '99. You can see there, Cisco is the dark blue-black line, and it's the MSCI IT sector index. You see Cisco there. If you bought it back at the peak of the market in 2000 and you still owned it today, you're probably still 20 or so % below where you were when you bought it. Despite the tech sector having such a strong rally, it's never got back to that peak. And it's just something to be aware of. Stocks like Nvidia are valued at a relatively similar level that Cisco was. Very different companies. NVIDIA seems to be at the forefront of so many things and may continue to do so, but its competitors are coming after it. And it won't be long before its competitors do come up with some solutions that NVIDIA is currently solving, and NVIDIA may struggle a little bit. So in terms of how we do things, areas of concern for us around passive investing, I think fixed income is a key area. And it's certainly an area where our portfolios, looking at peer comparisons against the various passive providers, certainly at the lower end, 2022 was a really, really tough year, because owning a lot of fixed income in a market where rates are going up as fast as they did was really being in the wrong place at the wrong time. And the problem with passive investing in fixed income markets is that the indices typically give the highest weight to those countries and companies that have the most debt in issuance. So with passive investing, you're just giving more and more money to the companies that have most debt, which isn't always a good thing. And obviously, those companies can go bust, and that's something that we're slightly concerned about at the moment. We're seeing an increase in companies defaulting. And that would have massive repercussions on fixed income markets. So that means, from our point of view, we think active, certainly in fixed income, does make more sense than passive, because we'd spend a lot of time understanding the creditworthiness of the company or the country, and really looking for, as much as anything, it's avoiding things that potentially can go wrong. In equities, again, we can pick and choose what we want to own. We've got various metrics we look at here. I won't go through all of them in terms of durability of the company, alignment with management, and all those sort of good things that you've heard from active fund managers over the years. We also, we use them. We look at return on invested capital, total shareholder returns, P ratios are obviously important, and that helps us build our equity portfolios. And again, it's not just buying companies at any valuation. We unfortunately didn't own NVIDIA, but we have owned Amazon, Microsoft, AMD, all sorts of other companies that are really connected to that whole AI world and have done extremely well. But for us, it's about making sure that we understand the value of the company, and we believe in the forecasts that we should see significant returns over the longer term. And finally, in a world where we're now starting to see higher correlation between bonds and equities, we think there's a strong reason to be looking at alternatives. And this has been quite a difficult area for the last couple of years, as I'm sure many of you are aware, with the property market, the real estate investment trust companies in the UK really having a tough time. Because in many ways, alternatives such as property are correlated to fixed income. They're like a cousin to the fixed income market. So when the fixed income market does badly, so do these typically to assets like property. But we believe that there are significant opportunities. We're starting to see private equity firms coming into the area, looking at opportunities, and we're seeing takeovers happening. And we're starting to see, as interest rates start coming down, investors are going to start looking for alternative places to get the yield. And a lot of assets in the alternative area, across property and infrastructure in particular, do provide significant income returns. So if one is comfortable with the valuations or one is comfortable with the share price of, say, a real estate investment trust, which is currently trading at, say, 20% below the asset value of the underlying holdings, that's quite a nice way to get into an asset which is maybe yielding 6 or 7%, which, if we see that share price recover 20% over the next 3 years, and you're continuing to get 6-7% income, that's a significant return over the next few years. If, as and when interest rates start coming down and the bond market does what it will do, which is go up, but it's relatively limited. Interest rates are not, we don't think, and I go back to 0-1% in the near future, unless we go into a really, really difficult economic period, which at the moment we don't think there will be. But from our point of view, we've got the real assets fund in our MPS portfolios, giving exposure to those alternatives on the right. We've also got the absolute return fund, which has got a variety of hedge funds. Not all of them are available via platform, across sort of equity market neutral, long, short, absolute return bond type funds. We've got some very short dated fixed income in there, so very high quality, sort of 6 months duration fixed income, and structured notes. And the structured notes, or structured opportunities as we call it, gives us the opportunity to play themes in the market. 2022, we'd bought one which was long value stocks, short growth stocks, and that played out well. So it's a way for the team to provide low risk returns, and that fund, the absolute return fund's annualizing at around 6% at the moment. So we think that's a good diversification from traditional asset classes such as fixed income and equities. So in conclusion, it's not active or passive, but if we think there's a blend, if you're going to blend, then make sure you're blending with a portfolio that is fully active. Otherwise, you can end up doubling up a lot of your returns. So I'm not going to go through all of these. And I think we have a risk page that compliance say that we need to show at the end, which I'm sure you'll love to read. But we can send these out to you if that's of any interest. I think we might have a question. So the question is an open question, but where do you see the future of active management heading? It's a great question, and it's a tough one to answer, because if active managers can go into a period of outperforming the index, then they will obviously attract more capital. But at the moment, they're pricing themselves out of the market. And we're seeing that the fund managers that can perform, they have performed and they continue to perform, and they're forced into closing their funds. Otherwise, you end up with multi-billion-pound funds and you watch the outperformance disappear. So I think active is going to have a place in markets and investing for a long time, and for the foreseeable future. I can't see any reason why not. Particularly, something we haven't mentioned before is within our equity fund, we've got a protection strategy, so we can protect on the downside. If you own passive vehicles, there is absolutely no protection other than selling those assets, and that's a timing issue, and that's not always very easy to do. So I think lower costs from the active fund managers would help, but also strong performance, and they've got to start outperforming those indices. But from our point of view, it's less of an issue because our costs as a result of the way we do things are relatively low, and we can choose what we own.
I think the other trend, Jim, that we sort of noticed within the active market is that houses that have been traditionally fund of fund investors, if you see what I mean, on an active basis, investing in other managers, outsourcing to other managers, active funds, that's been a difficult place to be, just because, as you said, the costs of doing that can really ramp up very quickly and sort of devalue the benefits of active management overall. So that sort of trend away from fund of fund managers, I think, is something that we've been seeing in the marketplace.
Yeah. Another question. The best way to or best approach to educating clients about the benefits and risks of active and passive. I think price is a good starting point. Obviously, passive is very low cost. I think that the way I talk to clients about it is I show them what happens when the markets fall. And that's where I think active managers should outperform, particularly in very sharp sell-offs. In March 2020, for example, if you look at passive strategies, they had no defense against falling markets. So you as the advisor and or the client would have to come to a decision: do you sell or do you hold and wait? 2022, again, with fixed income markets, I think there are some passive strategies that may well still be showing very, very low, if any, returns over a 3-year, 4-year period. So I think it's about price, but it's also about that performance during difficult periods. And if they are comfortable that they have no protection against falling markets, and there's no guarantee active managers will outperform a falling market, but at least they're having a go. And I think that's what I would focus on, is just showing, and we saw it recently with that very sharp sell-off that started in Japan and then spread across the rest of the world in August. That would be quite a good way of just showing the benefits of an active manager if they outperform during that period. We've got a final question. I'm just going to read it. How can active managers outperform when they're performing against themselves as a whole? When they outperform, who is underperforming on the side? Well, there's other active funds which are underperforming, and we've seen that. Is it Lancat's dog list? There's a firm out there. I can't remember who it is, but every year they produce a list of the underperforming funds. And so, index returns are one thing, but there are also going to be active managers that significantly outperform and those that underperform. So it's, they are fighting against each other, but also fighting against the index and trying to outperform. And that's why you see such a huge variety of funds still to this day, and fund managers telling you that they're the best at understanding the US equity market, whereas in reality, very few manage to outperform. Well, hopefully, if there are any more questions.
It looks like that's it for questions, and we are indeed almost out of time as well. So, but thank you very much, Jim and Mark. That was really interesting. Certainly a couple of things in there that I feel I should have known that and didn't. For example, in the US, the passive funds now accounting for greater AUM than actively managed, and also just the point about the top 10 stocks in the FTSE accounting 50% of the capitalisation, if I've pulled that correctly. And also the piece at the end regarding the place of alternatives with equities and bonds now being so closely correlated. So yes, some really good stuff in there. And thank you both very much indeed again for your time. I should say I think I forgot to introduce myself at the start. So I'm Darren. If you haven't spoken with me before, I'm one of the sales managers at Novia Global. So if you do have any questions about Waverton, their multi-asset funds or their MPS solutions, then do give me or your sales manager, which might be Chris, Connor, Paul, Rob, whoever it is, give us a shout and we can help you with that. But yeah, just leaves me to once again say thank you very much indeed to Jim and Mark for that, and for you all and to you all for joining us this morning. Thank you very much indeed.
Thanks, Dan.
Thanks, Darren.